Good afternoon, everyone. Today's video is designed for Futures Volatility Box members, and we'll do a recap, a little bit more detailed recap of the 4 index markets with today's trading activity. We'll cover the S&P 500 futures, the Dow futures, the Nasdaq futures, and also the Russell futures. So those are the 4 markets that we'll be looking at in today's video. Now, for those of you that are new to the channel, or maybe even new to the Futures Volatility Box, or you simply want a refresher, I would watch these 2 videos before you continue forward. The first breaks down the setup, rule, and examples that I'll be discussing in today's video, and that walks you step by step what you're looking for in an ideal setup. The second video walks through the actual process of how we go about adapting to increased volatility as the day progresses. That will walk through the explanations and the logic behind these 5 models up here, which you'll see me switch between in this particular video. Now, with that, let's get started. So again, I'll leave a link to these 2 videos. If you've already seen them or you know the concepts, let's get started with the S&P 500 futures here first. Now, in the morning, to start off the day, we were on the Scalper Volatility Box models, our most aggressive model available to us. Even up until the morning volatility note was sent around 7:30, we were still on the scalper inside of the S&P 500. Then we had buying activity continue really from 7:30 all the way up outside of that 8 a.m. Pacific hour, where price action continued to rally, breaking outside of our volatility clouds. Now, this break outside of the clouds happened before we saw an edge signal confirmation, so no trade or setup rules weren't met, but this did give us information that, hey, the scalper is no longer doing a good job of containing price action. We aren't seeing sellers come in and defend the areas that we expect them to. Let's be a little bit more conservative, switch to the next model in line, which is the aggressive volatility box models. Now, the aggressive models do a much better job of containing price action in that same period. We do get that breach, but we see the edge signal a little too late, and this is all towards the end of an hour. So no active trade setup. We never get our retest, but we do see that the sellers are able to defend that level. So this increases our confidence, but no trade setup. Now we're waiting for the next breach in line. The next hour goes through 8 to 9 a.m. Pacific, no trade. 9 to 10 a.m. Pacific, no trade. But in that 10 to 11 a.m. Pacific hour, we see sellers now take control. We breach our volatility zones, and again, we go outside of the clouds before seeing the green arrow. Once we go outside of the clouds here, we know now the aggressive isn't able to contain price action either. We adapt one more model, and that takes us to the doomsday aggressive model. Here we do have a breach of our sign lines with this red candle right here. We then get the edge signal confirmation, so now our rules have been met, and we're waiting for a retest of this sign line, which we get with 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, and 20 candles. It's almost 20 minutes of price action just chopping around sideways here right near our entry point. Our stop is outside of the volatility box clouds near 40.95. Our entry was at 41.06, so right around an 11-point risk on this particular trade, and we're looking for the same 11 points on the opposite side for our target. Whoops, let me zoom back out. So from the actual entry price, we had given this trade about 11 points. On this first leg up, we made it to 10.75, but not quite 11. So you had to sit through this little pullback here. T1 had not yet been hit, but in the next leg higher is where T1 was actually hit. Once we hit that first target of 11 points, our stop was then moved from 40.95 up to our entry price, so right near that 41.06 area. In this downward decline, that's where that stop on the second batch of contracts got hit. In terms of what we were targeting on the upside, which we didn't hit, that was 41.32, the gray target line on the opposite side. Then for the rest of the day, we ended up chopping in between our volatility box zones. So that 10 to 11 a.m. Pacific hour and this little bounce was the one trade inside of the S&P 500 futures. Now let's move on next to the Nasdaq futures. So let me switch over to NQ. And inside of the Nasdaq, we started similar to the S&P on the scalper volatility box models. To start off the day, we were really just chopping around sideways, and even up until 7:30 when the note was sent out, the scalper on the Nasdaq was the model to use. Then similar to the S&P, we had buyers come in, take price action up outside of the clouds, and that happened before we saw the edge signal. So that takes us from the scalper to the aggressive. So far, we're following a very similar timeline as the S&P 500 futures. You'll notice when we get to the Dow is the one that's the odd man out today. Anyways, back to the Nasdaq here. So the aggressive, very similar to the S&P, does a much better job of containing price action, capturing this little dip, and we see that being confirmed with the edge signal, but no retest. So confidence is built here, but no trade setup. Now we keep coming forward, and unlike the S&P 500, the Nasdaq did hit the upper edge of our volatility box zones 1 hour before we had a trade setup in the S&P 500. So our first setup in the Nasdaq was in the 9 to 10 a.m. Pacific hour, when buyers again continued to rally price action up inside of our volatility box zone. This is step 1 of our setup. Then we're waiting for the edge signal confirmation, step 2, and once both of those are met, we're looking for a retest of this sign entry line. We got the retest with price action pulling back here with this first green candle. Our entry was near that 1375 mark. Our stop was outside of the 13100 mark, closer to 13106. The risk on that particular trade, sign line to the outer edge of the clouds, right around 31 points. In terms of the actual target we were looking for, that was the same 31 points on the reverse, which was met in this leg move down lower, the second leg in this overall downward decline, where sellers then brought price action to T1. Now at this point, the stop is moved from outside of the volatility box clouds to break even. So from that 13106 mark all the way up to 1375, which allows you to even protect a little bit. Now we're targeting the second target, which is the target line, which is at the 13,000 round number mark. If we keep scrolling forward, you'll notice price action chops, and then we have sellers really coming in, taking us to T2. So again, to draw out the two different trade setups, the first setup only was about 31 points. I use the word only in quotation marks because that was 31 points, but we actually risked the same 31 points to try and make that first target. Then we had the luxury of moving our stop to break even, so now you're playing with a quote-unquote on the house setup, and our second target was 75.92, so 76 points, really 75 if you took it off a little before that 13,000 round number mark to be a little bit safer there. So you can see how that second trade really serves as the home run sort of trade. While T1 was a nice target, 31 points in the Nasdaq, T2 is where the day's gains are really able to be made, especially when you're operating from a break-even mindset. Then continuing forward, that wasn't really the end of price action with that dip. Once we had that dip, that then took us to another long entry, a breach, which again went outside of the clouds before we saw the green arrows in this case. That takes us from the aggressive now to the doomsday aggressive, same model that the S&P was on in that same hour. And here, very similar to the S&P, we had a breach of our sign entry lines. We then had the edge signal confirmation, and we had an opportunity to enter at a price better than the sign entry line. Here again, using the sign entry line to the outer edge of the clouds, we're really playing a bounce from near that 12,950 mark. That was giving this trade a risk of right around 44, 45 points, depending on where you gave the stop. And in terms of the upward first leg up higher, made it to about 32 points before again having a pullback to the market pulse. And in that second leg higher, just like the S&P, that's where you ended up hitting the actual target with this first big green candle here. Stop move to break even, which was then taken out when price action reversed in this move with these three larger red candles, So zooming back out here, the Nasdaq on the second setup hit just a T1. So two setups inside of the Nasdaq using two different models. The first one was the nicer trade of the two. The second one was in line with the S&P, and what we'll find is the Dow as well. So that then takes us to the Dow futures market. The Dow futures, like I said, was the odd one out because we started not on the scalper volatility box models, because price had already broken outside of the scalper early on in the day in that 6:30 to 7 a.m. Pacific mark. So the scalper had already been broken. We knew selling activity inside of the Dow was a little bit greater compared to the S&P and the Nasdaq. So the aggressive was the model we were using. Same time period as the other two markets we just discussed. We had a breach towards that 10 to 11 a.m. hour. Price went outside of the clouds before we saw the green arrow, which then took us from the aggressive to the doomsday aggressive volatility box models. We had the breach, we had the edge signal confirmation, and we had a retest of the cyan line. Here inside of the Dow, our risk that we had to give this particular trade was about 75 points. We were looking for the same 75 points, only made it to 71 in the first leg, came almost back down to break even, and in the second leg higher is where we took T1, and then the stop was taken off at break even. So in the Dow, just this one trade setup as well. And finally, we move on to the last index market, the Russell futures. The small caps always tend to get interesting on volatile days. Inside of the Russell, a little bit different price activity here. Started on the scalper, stayed through the scalper in that 7 to 8 a.m. Pacific hour as well. We breached the scalper sign entry line, and then we had sellers defend that level. So far the scalper is good. Even in the 8 to 9 a.m. Pacific hour, scalper is good. Now 9 to 10 a.m. Pacific hour gets hit, and there, similar to the Nasdaq, we have price action rally into the upper sign entry line, so that's step 1. We then have the edge signal confirmation, that's step 2. The entry was near 1902.1. The stop is outside of the volatility box clouds, outside of really 1905. The risk we've given this trade is right around 3 points. And coming down here, that 3 points is hit in this first move down lower, depending on where you got your entry, or if you had to wait through a little pullback, in the next leg down, you made it to 3.8 points. Then you had the luxury of moving your stop to break even, so right back to that 1902 area, and we're targeting T2's great target line, which in the case of the Russell was right near 1893, and that gave us a target of right around 9.1 points on the second contract. So much greater again on T2 compared to T1 in the Russell, and this first trade you'll notice was the nicer trade inside of the Russell. With the sell-off, price then goes outside of our volatility box clouds for the first time in the day, so volatility here picks up much later on in the Russell compared to the other 3 indices. Now we have to adapt to the new volatility. We switch to the aggressive. The aggressive gets breached here, sign entry line. We then get the edge signal confirmation. Our risk on this particular trade is right around 4.1 points. Inside of the Russell, we test that level, get close to it, and then we have buyers defend that zone, again taking us up all the way to 6.7, just like the other 3 index markets with that first leg higher. So that was the Russell futures. You'll notice inside of the Nasdaq and the Russell, we had 2 trades, one short, one long, versus the S&P 500 and the Dow futures, we had just one setup in each, which was only a long side setup. So hopefully today's in-depth video walks you through each one of the different setups we had on each model in the 4 index markets. Again, these are the 2 videos that I would review if you're still a little bit confused around some of the processes. The first video walks through the setup rules and a few different examples on that particular day, and this is from 2022. And the second video walks you through the process of, again, adapting to the changing volatility using the 5 different models. All right, take care everyone, good luck trading, and we'll see you in the next update.